All right, Steve here. The 4 o'clock bell just rang on an absolutely high-velocity session. Welcome to this explainer of the Thursday, May 21st Market Closing Report. We're going to cut right through the noise, look at the raw closing data, and break down exactly what the structural architecture of the market is telling us right now. Because look, while the retail crowd spent the afternoon chasing headline gossip on their phones, the smart money, they were tracking a massive, mechanical shift in the bond market. So we're diving right into the tape today. We're stripping away the emotion to look at the actual mechanics that drove the price action.
And hey, I want to start by framing our entire perspective with a hard truth. If you are trading this tape on blind optimism, you are the one being traded. As a veteran in these pits, I can tell you straight up that hope is not a risk management strategy. This market is ruthless right now. It's algorithmically driven, it's structurally complex. If you're just buying the dip because some talking head on TV told you the worst is over, well, you're just providing exit liquidity for institutional desks. Our job today is to look at the data, read the tape, and understand the heady mechanics operating just beneath the surface. Let's move to the data and see what today's close is actually built on.
Okay, moving to Section 1, Thursday's closing tape.
Now this is the unvarnished truth straight from the bell. Let's take a hard look at the critical levels on the board. The S&P 500 actually managed to claw back its early losses, catching a late afternoon bid to close green, up 0.17% at 7445.72. The equity pits basically used a cooling energy sector to build the defensive perimeter right into the final bell. Notice Brent crude right there in the second row. It extended its slide for a third straight session, settling down at $104.14 a barrel. That 3-day slide, that is the primary catalyst for the equity bounce today. The algorithm desks are clearly pricing in some temporary diplomatic optimism. Meanwhile, gold stayed heavy, remaining under pressure near $4,506, and Bitcoin held a pretty steady, consolidating floor right at 76,981.
Now what's really fascinating is the structure we're seeing in the S&P 500 futures, the ES. Look at that price action on the right side. That late afternoon bid allowed the market to reclaim a steady footing above that absolutely critical 7,400 shelf. You can even see the heavy volume bars at the bottom supporting that move. The smart money actually stepped in to defend that zone. But to understand why they felt comfortable buying at that level today, we've got to look away from the equity board and focus on what the fixed income desks were doing.
That brings us to Section 2, the yield relief valve. The bounce you saw in the S&P 500 today, it wasn't about some sudden burst of corporate exuberance. Not at all. It was entirely a function of the bond market letting off pressure. 4.59%. Lock this number into your mind. This was the massive mechanical shift of the day. The 10-year Treasury yield pulled back down to 4.59%. In the macro environment, that 10-year yield acts like gravity on equity valuations, especially for those mega-cap tech stocks. When that yield drops, the gravity lessens.
And looking right here at the U.S. 10-year Treasury yield, you can clearly see that pullback, offering some temporary breathing room. This drop gave the mega-cap tech giants exactly what they needed to protect their corporate valuations ahead of some major upcoming sector earnings. But listen, as a trader, you've got to remain completely objective. Do not mistake a temporary easing of interest rate gravity for a permanent change in the macroeconomic trend. Because honestly, we are still facing a really harsh structural reality on Main Street. We're dealing with the structural inflation tax, core inflation is sticky, wholesale pressures remain incredibly high, and the national average for gas is stubbornly holding at $4.56 a gallon. The consumer's real discretionary margin is literally still bleeding out. You've got to keep this broader context in mind when you're evaluating the strength of a one-day equity bounce. The macro headwinds haven't just magically vanished because bond yields dipped for an afternoon.
Right, on to Section 3, Strait of Hormuz standoff. So what is actually capping the global market right now? Let's peel back the final layer and look at the geopolitical ledger. This is the undersea chess match that's dictating the price of crude, which in turn, like we just saw, dictates the breathing room for equities. Look at this staggering figure, negative 90%. While the drop in crude today tells you the market algorithms want to price in peace, the hard ground truth inside the Strait of Hormuz remains highly restricted. Commercial shipping desks confirm that Western merchant volume navigating through this critical global choke point remains down more than 90% below normal baseline levels. The global supply chain is essentially paralyzed in that corridor. Let's break down the specific friction points causing this global paralysis. First off, Tehran's newly minted Strait Authority continues to try and enforce arbitrary vetting and transit fees, basically setting up a new toll booth on global commerce.
Second, look at their domestic situation. Iran's war-damaged power grid is entering peak seasonal demand with a massive 25,000 megawatt structural shortfall. That's causing rolling blackouts across 2,000 zones. Finally, and this is the really explosive catalyst, the U.S. administration's temporary hold on kinetic airstrikes is strictly conditional on a complete reopening of the waterway. The ultimatum is set. If this new tolling mechanism permanently chokes off international commerce, the pause is over, and the operational mandate to target Iran's remaining civil infrastructure goes fully live. That is the powder keg the market is currently sitting on.
Let's shift to Section 4, Bull versus Bear Scenarios.
Knowing that threat, how are the institutional heavy hitters positioning themselves for the fallout? The crucial point here is understanding both sides of the book. The bullish view is betting that back-channel mediation forces a compromise on shipping rules. If they can clear the minefields, crude could get sent back down to the $80 range. If that happens, the relief on inflation metrics triggers a massive S&P short squeeze right past 7,600. But you gotta look at the bearish view. The bears are betting this current relief rally is a massive trap inside a structural stagflation cycle. With global energy reserves already deeply depleted, any breakdown in the current diplomatic track, any kinetic escalation, is going to send crude straight to $150 a barrel. And if crude hits 150, it will completely wipe today's equity buyers right off the ledger.
All right, bringing it home with Section 5, the final trading directive.
As serious tape readers, we don't trade the news, and we sure don't trade the excitement. We trade the structure. I want you to burn these 3 tactical steps into your trading plan for the upcoming sessions. Step 1. Watch the 7,400 pivot floor on the ES futures. Yes, we're trading above it right now, but it remains the critical line in the sand. If the futures break below 7,400 on heavy volume, the bear market correction resumes immediately. Step 2. Track Brent crude strictly at its current level of $104.14. Step 3. In this environment, you must trade small sizes and use tight stops. Keep your execution clean and stay completely disciplined with your averages. Actually, I want to emphasize Step 2 for a second. This right here is Brent crude, the BZ contract. This is your true North Star for the current equity relief rally. Everything hinges on this energy macro architecture. Brent is sitting at 104.14. Listen to me. If crude catches a bid and pushes back over $108, the equity relief rally in the S&P is dead on arrival. The inflation tax will spike, yields are going to rise, and equities will flush. You need to watch this closer than you watch your own stocks. I want to leave you with this final, provocative thought to really summarize our read of the tape today. Berkshire Hathaway is sitting on $397 billion in cash for a distinct reason. Take a cue from the big money, from operators like Greg Abel. They're preserving capital. When the geopolitical landscape is sitting on a knife's edge between a short squeeze and $150 oil, collecting a guaranteed 5% risk-free return on short-term paper is arguably the smartest trade on the board until things stabilize. Follow the big money, protect your downside, respect the tape, and I will see you at the morning bell. The ledger is closed.